Good afternoon and welcome to our 2025 Crystal Ball Outlook presentation. I'm Katrina Radenberg, Chief Investment Officer at Mariner, and I am joined today by my colleague, Jeff Krumpelman, who is our Chief Investment Strategist and Head of Equities. We look forward to spending time with you each January to review what happened in the prior 12 months and to share our expectations for the upcoming year. This year is no different. We would like to thank all of you for joining us today. Jeff, I thank you for joining us. Interestingly enough, the agenda is always the same for our presentation, yet there is never a shortage of new and thought-provoking issues to cover. The financial markets always seem to provide us with plenty of good material to discuss. The good news for us is that means there should be very few dull moments in serving as your host today. We hope you find this presentation helpful, that it addresses any concerns that you may have, your curiosities, and your interests. Jeff, are you ready for this?
Absolutely, Katrina. You know how much I enjoy doing this. So
I do. I love it. Great. Okay, so then let's go ahead and get started. If you do have any questions, please feel free to type them in the box and we'll do our best to address them along the way. If we do not get to them, we will have someone follow up with you after the fact. All right. So, Jeff, do you see my screen on 2024 now?
Yeah.
Okay.
I do. Yep.
All right. So I'm going to begin by just doing a quick review of what we saw. And similar to our opening remarks last year at this time, I'm going to use the word wow again to describe 2024 equity returns. In fact, the end results for the S&P 500 were robust and virtually identical in both years. Specifically, the S&P 500 returned 25% in 2024, very close to the stellar 26.3% total gain in 2023. As you can see in this slide, growth stocks, as captured by the Russell 1000 Growth Index, surged more than 30%, and more than doubled the mere 14% return of value stocks represented by the Russell 1000 Value Index in 2024. In an absolute sense, both types of stocks did well, and we are glad that we recommended a blend of both this year again. As we look at domestic stocks, well outperformed international stocks again, as the U.S. economy truly was the envy of the world, despite an atmosphere created by media headlines throughout the year, which tried to get our attention focused more on the problems in the U.S. economy than on some of the more impressive attributes like superior growth and innovation. From a sector standpoint, the U.S. equity market did broaden in leadership as we moved through the year, with not just tech stocks posting gains in excess of 30%, but with consumer discretionary and financial stocks generating similarly impressive positive 30% gains. The utilities and industrials saw double-digit gains as well. This broadening in leadership in the second half was good to see. 2024 was not just about the mega cap Magnificent Seven, though the Mag 7 have nothing to apologize for either and also closed the year on a high note. I would also add that this continued bull run during 2024 was grounded in solid trends in the fundamentals, including continued expansion in the economy and a pace in real GDP growth that was above expectations, solid labor market conditions, strong earnings growth, and positive trend in profit margin, just to name a few. These healthy trends in the data allowed the S&P 500 to climb a wall of worry that was not insignificant either throughout the year. The market did lose momentum and stall its advance a bit in December, but all told, it was a really solid year. Jeff, anything you would like to add?
Yeah, I think, Katrina, I would add that while the returns that you mentioned were very similar between 25 and 24, robust 25%-ish plus, returns, we'd have to give the style points to 2023. It was just in 2023, the market, the S&P 500 really stuck the landing nicely. We had a lot of momentum going into the locker room. You had a Santa Claus rally. Stocks were up at the end of 2023, 14% in the final 2 months. And it just gave you a real sense of excitement for what could come to be and continue in 2024. And that is not the mood that we have seen as we go into this new year in 2025. We're kind of limping into the locker room, and leadership narrowed fairly significantly after it had broadened, like you just said, in that second half of the year. But in December, it came back to the tried and true, the big Mag 7 and those kinds of things. We'd had a wonderful rally in November. After the election, I think we had a relief rally where people just kind of went, okay, there's not going to be a contested election. We're going to have a peaceful transfer of power. That's all good. And some of these policies, tax cuts, deregulation, wow. But then I think in December, people kind of said, time out. It's been a heck of a run. And, maybe some of these things in terms of policy, like the tariffs, like deportation strategies that could result, they might actually cause inflation and slow down the economy. Let's don't get carried away. And so if you looked at the technicals, the numbers of stocks advancing versus declining, that rolled over a little bit. Wasn't terrible, but it rolled over and stalled. If you look at the percentage stocks trading above the 50-day and 200-day moving average, that kind of plummeted in terms of those percentages. And the market just looked tired as we go into this year. So it might be trying to tell us something in terms of a bit of a pause. So, the commercial real quick up front, as we're talking about history, would be that this year, while we do expect positive returns, not of the magnitude that we saw last year. And we're going to have some volatility as news flow develops and maybe less than perfect every month data kind of comes out. At 22 times earnings, get ready for some air pockets. And that, our theme this year, unlike previous years where we're very positive, is clear air turbulence. And we'll talk about that in just a second. So that would be the main point I would add.
Great. Thank you.
Sure.
Now going into, did you want to address anything as we move to this next slide?
Yeah, I do. I think that, as part of this kind of idea that you need to be a little more aware of volatility that may come up, intra-year, during the year. There could be a couple of imbalances that have developed in client portfolios over the last year, because we are up 60%, cumulatively. And if you look at this chart that you've got up, Katrina, U.S. stock market capitalization as a percent of total global stock market capitalization, that gray line at the top, that's moved up from 40%. U.S. stocks were 40% of total stock market value in the world. Not too long ago, 40 to 45% only 10 years ago. It's now at 67%. That's at all-time highs. So for those folks, we've maintained a domestic large and mid-cap bias for some time. We maintain that. But for those that have been reticent to stick your toe in the water in international equities, it may be a time to be thoughtful about that and think about exposure internationally if you don't have it, given this very big run of outperformance of S&P 500. And I would add, we don't have a chart on it, but the other thing that people may not realize in terms of embedded risks and imbalances, as growth stocks, like you just cited, went up 33% last year, and they way outperformed in the previous year in 2023 too, over value stocks. These growth-oriented stocks, Mag 7 and so forth, have created concentrations. If you're a passive investor in the S&P 500, the top 10 stocks represent over 40% of value of the S&P 500. They represent close to 55% of the Russell 1000 Growth Index. We love NVIDIA. It's got great fundamentals, but I don't think I'd want to own 12% of it as the passive Russell 1000 Growth Index has exposure at that level to that stock. And the S&P is probably close to 10%. So we like it, but just be careful of the growth concentration that may have built up if you're a passive investor or even in some of your active strategies. That's what we do love about having some active management exposure, which can be more diversified than that, not so concentrated.
You're starting to get into 2025 outlook already, which is great. That's why we're here. But before we get too far down that road, I'm going to slow you down and ask you to talk about as we look back at 24, what did we get right and what could we have done better in relation to our equity calls?
Well, I appreciate you pulling the reins back a little bit.
Yeah. We'll just this last thing, and then we'll get going.
Okay. Well, so in reflecting back on the year, I think we are pretty pleased, gratified, whatever the word is, with the message that we had last year. We forecast healthy returns in 2024. We had a target. We actually underachieved, on that basis. We had a target of 5,200 in our base case, an upside of 5,400. And I think we ended the year somewhere around 5,900. So, but we got the trend right, and we really thought we'd have healthy returns of 20%-ish like we have had. We had a return to normal thesis. And by that, as we explained, through the year, we were looking for a return to normal in the economy to grow, 2.5%. Or a little better. It certainly did that. We were looking for earnings growth of double-digit levels, which it did. We thought the Fed would start to normalize its policy, which it did do, and it cut a couple times, and that's all we were looking for. We thought treasuries would be trading right about at the range that they are right now. So we got our return to normal thesis, I think, was pretty spot on. We made that strategic decision to not run away from growth stocks, but to maintain that balance, which you mentioned. And we did favor domestic over international and large over small. So all those things, I think, were helpful in our conversations with clients and internal management. What we missed, we did miss the magnitude of the strength in large U.S. stocks. As I said, we finished at 5,900. But the nice thing about that is seldom do you get fired for going to your year-end review and telling people that they were wealthier faster than you thought they would be, while you had them invested at a normal, healthy level in terms of equity targets. And the other thing that we did do, as you know, my team manages 6 different strategies in individual stocks, ranging from conservative to very aggressive and then middle of the road or balanced. And, we have great, I think, track records when you look at our peer universe performance. But in our most aggressive strategy, we started to pare back away from the Mag 7 and invest in smaller or mid-cap growth stocks. I think just a little early. We think, we'll be rewarded for that. But in that one particular aggressive strategy, we diversified too quickly. So, I think those are very surmountable, but overall pretty pleased with what we got right.
Awesome. Thank you.
Sure.
And then if we go on to the next slide here, I think you wanted to talk a little bit more about some of the price targets in the...
This I put up here just for fun because I think it kind of sets the table a little bit for our message. We've been ultra contrarian bulls over the last 2 years, and we were high on the street. We're top of the heap in both years. As I mentioned last year, 5,200. You see a who's who list of Wall Street firms and RIA strategists here. And in 2022, we were very contrarian, also close to top of the list with a target of 4,500. We had an optimistic target of 4,800, and we finished the year about there last year. So I just, point this out that there is no, patent or brand name on, good analysis. But I think we are gratified that relative to the pack, we've had a very positive message. Hold your ground, be at your long-term normal asset allocation target in a world in which many, many folks were bearish or had much lower expectations. And, I think we're gratified with that. And it paid off. And we were not contrarian just for the sake of being contrarian. It was really, based on the data. And what's interesting to us is that this year, while we had been accused of having those rose-colored glasses on in 2023 and 2024, just about the time that we're taking ours off, many folks are putting them on. And again, we think we'll have a solid year, but when you are priced at 22 times earnings, if you don't get just perfect data, on a monthly basis, or if there's a tweet about, invading Canada or Greenland or what have you, or, things just don't go quite as well with some of the news flow on, policies that are out there, there's not as much of a cushion or a margin for error. And you can hit those little air pockets. So we're middle of the pack for next year. And we think we'll do well, but we are less bullish than some of the other folks this year.
Great. That sets the table really nicely. So we can now actually start moving into discussing more around our base case for 2025 and some of those alternative scenarios. So can you guide us through those now?
Yeah, sure can. So, we do this every year and then we post this. So this is out there. You can fact check this, every year on what we're thinking. And, we always have a base case or our most likely case that we see playing out. And you see that in the yellow or the gold. We assign a 50% probability that the S&P 500 trades at 6,600 by calendar year end next year. That'd be a nice 12% price return. If you throw in some dividends, it would be 14%-ish. So, a decent year, but more in line with, historical norms than the 20% plus kind of returns we've seen over the last couple of years. Now, the assumptions for that outcome are up at the top. And, they're pretty reasonable and rational. We're looking for real GDP growth of 2 to 2.5%. That's a little slower, actually, than 2024's real GDP growth is probably going to come in at. I think that will come in north of 2.5%. We're looking for a Fed funds neutral rate and eventual rate this year of somewhere around 4%. So, a couple cuts, we think what the Fed's doing is very rational. Inflation's calming. The economy's not going into recession. So they really don't need to do a lot right in here. And, last year, going into the year, people said that we better have 6 or 7 cuts. And if we don't, there's going to be a market meltdown. And we certainly didn't see that. We thought that was overdone. And I think people need to relax a little bit with speculation about what, the Fed needs to do. It seems like it's doing a very reasonable job. The 10-year Treasury, we think, will trade in a range of 3.5% to 5% with an average of around 4.5%, which is right where we're at right now. And again, that's based on, reasonable 3 yards in a cloud of dust type of GDP growth and inflation's that is calming. So we think that's a reasonable level for rates and a healthy level for rates. And then we're looking for S&P 500 earnings growth of 10 to 12% in 25 and equal to that or a little bit better in 26, the way profit margin trends are going, labor trends and labor productivity and just overall GDP growth. So if you just put the math to it, those things play out in terms of assumptions. You hang a 21.5 multiple on things, you get that 6,600 target. Now, things could go better than planned as they have over the last 2 years. And, if, for example, I think there is a lot of concern about the unknowns. What might happen on the policy front? Will inflation, resurrect itself a little bit and reaccelerate a little bit? Do we have too much debt? And would that maybe drive rates up just a little bit? I think all those things will be resolved very adequately. And when investors get confidence that's the case, or if they do, I think you could see a slight lift to multiples up to the 22 or slightly above levels. Hopefully not 23, 24, 25. That harkens back to the tech bubble-ish. But I think you could get a little lift and you deliver on the earnings, you get 7,000. 20% chance of that. 10% chance that we go nowhere. And that would be where these things take longer to resolve in folks' minds. With regard to tariffs, what actually happens, what impact that may have, when they happen, that kind of stuff. You could get maybe a little bit of multiple contraction from 20 to 18-ish or so. And that might impact earnings just a little bit if CEO confidence lightens up a little bit and hiring plans come in a little bit and spending comes in a little bit. Get a little lighter earnings, 280-ish in S&P 500 earnings, 18 multiple. And so, you get, or 20 multiple, I'm sorry, and you get more like 6,000. In the pessimistic case, we assign a 20% probability of that. And that's where, some of these policy issues really are kind of very disappointing or worst case in terms of impact and how aggressive they are. And earnings are 10% lighter and you really do contract 18 times. And then you get, 15% downdraft in price after dividend, a little less than that. It's not catastrophic, but it ain't no fun. And, I think even in our base case, the difference this year is while that's a more reasonable return compared to what we've seen, but I think it's going to be mixed in with a fair amount of volatility as we get this news flow through the year. But that's basically our outlook there.
Yeah, no, great. You did a really good job laying that out. So if we move on to the next slide, this shows what you had already alluded to on the prior 2 slides ago around our expectations for the year and how we really rank amongst the various strategies, noting that we're more kind of middle of the pack this year, and is a little bit different than what some might have called having a little bit of rose-colored glasses in 23 and 24. And so this really kind of helps everybody see where we are in regard to everybody else. Are there any other points that you want to make about the contrarian views that we maintain that you didn't already make on the prior slides?
Yeah, I get maybe one. And yeah, you're right. We're, as you can see, middle of the road, as you pointed out. I think that, sometimes in our industry, we try and get, pretty cute and talk about timing of what's going to happen. We try and avoid doing it. But it's interesting, I think, that many other firms were kind of in the mind going in, these people that do this, that this first part of the year might be really strong. That, it is true that we've gotten a bounce in CEO confidence and small business optimism post-election. And folks were kind of optimistic that the first 100 days would go really well. The tax cut kind of discussion would really gain some momentum. You get the deregulation and that kind of stuff going, some through executive order. And we'd have a really strong first half. And then maybe things would slow down a little bit in the second half as, we study things a little bit more and maybe there's some offsets to all the good news. We really kind of felt, the opposite going in. If you put a gun to our head as to, how things might play out, that, you might see a lot of tax loss or tax harvesting, taking gains, deferring capital gains from 2024 into early 2025, just defer them because there were so many gains that could be taken, to rebalance. And, that we just might get, a news flow number, an economic or earnings number that isn't perfect and spot on, and you get some chop early on in the first half. And it really doesn't matter, the timing of all that. At the end of the day, what's your target at the end of the year? But I do think that we're seeing early on this year, this idea of clear air turbulence. The definition of clear air turbulence is turbulence that happens in blue skies. You don't see it coming. There's no radar that will detect it. And it just kind of comes out of nowhere and causes anything. Planes don't crash. You make it to your final destination. You get to have a bunch of fun, but you're a little white-knuckled on that flight. And, we've already seen some of this just in the early part of this year. Like if you go back to December, we got some headlines about government shutdown, and the Fed was a little less optimistic about aggressive cuts, and the market didn't like it. And so we had a bad December. December was off about 2.5%. And then this year, going into the year, we got a payroll number just last week, and it was too robust. It was good news, but people said, "Uh-oh, that means the Fed ain't going to cut." So we fell back to 57.75 or so in the S&P, and then we got an inflation number out just the other day, and zoom, back to 59.50. Everything's okay. So I think get ready for that. We'll be at 6,600, but there's going to be some clear air turbulence here.
So I'm glad that you went there, because you did mention the concept of clear air turbulence in the monthly commentary last month, and you did suggest that we could have this bumpier ride. And so you explained the concept a little bit, but I think what would be helpful is if you also tie that into the context and the framework around our FVs and Ts.
Absolutely.
Can you do that?
Yep. So we've got, next slide, as you know, we've got our yoga chart, and I love to call it the yoga chart because you are a practitioner, and it does bring down blood pressure. You could call this the pickleball chart, or the painting chart, whatever, the dance or music chart, whatever people do to bring down their blood pressure. And the first thing I would say is that we look at 3 levels of analysis when we put together our outlook. We look at fundamental data, the trend in it, we rate it positive, neutral, or negative. There's all kinds of subcomponents under fundamental data that we look at and rate. We look at valuation, that's the second level of analysis, and different types of valuation metrics. And then we look at technical price trends. And there's all kinds of statistical data and technical data that we can look at that tell us what the true mood and buying preferences are of investors. Are they risk on, or are they risk off and scared? So the blue sky in the clear air turbulence analogy has to be the fundamentals. We don't have a lot of red minus signs up here. In fact, there's virtually none. But if you do look at economic trends, whether you're looking at manufacturing activity that has begun to reaccelerate, the service level activity in the U.S. economy is in very strong growth mode. Low unemployment, we went down, did a downtick in unemployment. We're at 4.1% unemployment. Consumers are employed and they're spending. Retail sales, good holiday season. Disposable income is positive. And it's really hard to find too many things to nit about, the U.S. economy. Housing isn't, where we would like it to be, but we're so diverse that you have to give the economic trends a positive. And I said overall, we're tracking close to 3% real GDP growth while inflation calms. Pretty darn good. Earnings trends are double digit. Fed policy, and after all those threats, the hike, we're in a cut kind of mode. And then I'll just skip down to M&A and IPO activity. That really reaccelerated in the fourth quarter. And you see these banks as they're now reporting their earnings, whether you're JP Morgan or Bank America, Goldman, so on and forth, Morgan Stanley. M&A activity and fee activity is just really solid. So positive sign there. And then credit spreads are tight. So bond investors that are buying corporates over treasuries are confident that default rates will remain low, and their demand for that spread and interest rate over treasuries is very tight. That's a really good sign. If we look at valuation, I know you're going to talk about this in a little bit, but we give it a neutral. 22 times at the aggregate level does sound high, and it is a yellow flag as part of that clear air turbulence thing. But there are reasons why valuation has risen. And I know you're going to talk about that, Katrina. So we give it a neutral. And it is comforting that, the top 7 names, the biggest 7, are trading at 30 times, whereas the other 493 are trading well below that, 18 times or below. And so that's why we give it a neutral, but you better be cautious. And then the technical price trends have just started to flatten out. And we'll look at the percentage of stocks trading above the 50-day and 200-day moving average, but momentum's come out of the market. And these other factors also tell us it looks tired. So clear air turbulence, blue skies with fundamentals. You got some air pockets down here in valuation and technicals, and you could get other air pockets where if the fundamental data on a monthly basis, 1 month the trend does not make, but if you get one that's just a little disappointing, you might get a few freak out moments on the part of investors.
Yeah, no, great. Thank you. And yes, as you alluded to, I'm going to shift gears and cover a few of those fundamental data points just to bring to life why we believe it's positive or blue sky in nature, as you alluded to. So if we go to this next slide here, hitting on inflation, this slide demonstrates that all measures of inflation, whether you're referencing CPI, PPI, or PCE, which are all the headline figures or the core calculations, all peaked in June of 2022 and have been improving since. Headline CPI has fallen from peak levels of 9% in 22 down to its most recent reading of 2.7%. Core PCE, which is a focus of the Fed, has fallen back to 2.8%. And while these are not perfect levels of inflation, and progress in further reductions has stalled a bit lately, but certainly this has been a blue sky trend and a key in providing the Fed with the opportunity to begin cutting the Fed funds rate in a measured fashion. Because the economy is holding up well and still growing nicely, they have not had to cut rates. I know you'll cover Fed policy a little bit more here later, Jeff, but so far so good on this front regarding inflation progress and Fed actions. We applaud what we've seen so far here. Moving to the next slide. Here we go. This one just provides some context as to why the economy and consumer spending, another key fundamental support to the market, in particular, has held up so well despite higher prices. First, let's focus on the graph on the left. The blue line captures the trend in CPI or inflation. The orange line depicts the trend in the rise in real wages. And yes, the CPI line shows that prices have increased more than 20% since pre-pandemic years. But importantly, nominal wages have increased more. So in other words, on a cumulative basis and after accounting for the rise in prices, consumers have increased take-home pay and spending power. And we don't feel like this is advertised quite enough. Then if we shift gears, the line graph on the right confirms and really tells us the same thing, but in a different way. The blue line shows the growth in nominal wages, and the orange line shows the growth in real or after inflation wages over time. During the pandemic, the growth in the nominal wages declined to only the 2% annualized level while inflation surged temporarily, and therefore real wage growth went negative. That's illustrated by the orange line or the real wage growth line, which you can see falling below 0. Note that as nominal wage growth has rebounded and stabilized at healthy levels and inflation has fallen, the orange line or the real wage growth has risen back at well above the zero line there in the black, and has now been positive for some 20 consecutive months. So this is another blue sky factor that has really helped to drive consumer spending. If we hit the next slide here, we'll shift gears into earnings and profit growth. We find that earnings have been far stronger than bearish forecasts that we saw in the beginning of 2023. You can see here that S&P 500 earnings have increased from 217 per share in 23 to 238 in 24 to 273 this year. And if we look into 2026, well above 300. So our take on this is this is not spelling out recession to us. The chart on the right captures the positive trend in profit margins resulting from better than expected economic growth coupled with cost efficiencies and rising labor productivity. emanating from AI and other tech innovation, as well as workers staying on the job rather than quitting so often for greener pastures. Then moving on, more good news about earnings in 2025. You can see here that most all sectors are contributing to S&P 500 earnings growth. The broad participation across the various S&P sectors is a really healthy sign. The bottom table you can see here kind of shows the earnings growth, or the positive earnings growth across all of the different sectors. You can see expectations are strong double-digit earnings growth in communication services, consumer discretionary, healthcare, industrials, materials, tech sectors. While even if you look at the financials and utilities, those still have high single-digit earnings growth this year. So the breadth is impressive. Jeff, I'll keep going here to address a couple more thoughts about valuation, if that sounds good.
Go for it. Yeah.
Okay.
Roll.
All right. I'm making up a little bit of time for us here. A couple of thoughts here. Let's see. Where are we? Yeah. You mentioned about full valuation earlier, and given that the S&P 500 is trading at roughly 22 times earnings, and I agree, this leaves little margin for error if there are surprise events or disappointing releases on the fundamentals. I also concur that it seemingly caps the upside in equity returns to the earnings growth that develops this year. We're not looking for multiple expansion from here. But at the same time, Jeff, I know you agree that the valuation index can stay higher at higher levels if the fundamentals are solid. And we've seen plenty of historical periods where this has happened. Higher PEs alone are not a reason to sell or to expect the market to roll over. In fact, our chief economist, Bill Greiner, has done some work on this recently that shows that the market performs quite well on a go-forward basis when PEs are in this range based on history. And then I'd like to point out on this slide also that there may be reason and good logic as to why PEs have elevated to these higher levels. There's been an upward drift in PEs since 2009 as innovation and cost efficiencies have taken even greater root, given the renewed corporate fiscal discipline that we began to see as we exited the Great Recession of 2007 and 2008. This coincides with the rise of ROE, or profitability levels, of the S&P 500 since that time. And you can see that here on this graph. The composition of the S&P 500 that was populated by slower growing, more mature industry groups going back to pre-1970 is far different than what we see today. And then, Jeff, I know that you will like this next slide because it syncs well with your thoughts often about the opportunities and advantages that we do see in active management. And it really, what this graph illustrates is that not all stocks are priced at 22 times level of the market cap weighted S&P 500 index that we're always referencing. The PE of this bellwether index is heavily influenced by the mega cap Mag 7 stocks that trade at average PEs above 30. Tesla, for an example, was trading at 120 times forward earnings at the beginning of the year. And if you look at the equal weighted S&P 500 on this chart, which gives equal weight to all S&P 500 constituents, its PE is significantly lower, as represented by the orange line, closer to 16 times. And we've discussed how our internal equity team that you manage and you mentioned earlier finds appealing PEs in a number of stocks that fall into the other 493 stocks that we have to choose from, or in these non-Mag 7 constituents. So valuation isn't quite as lofty if you start to really look under the hood.
Yeah, I absolutely agree with that, Katrina. And, our chief economist, Bill Greiner, who's served in our roles in previous lives at our firm and previous firms, has done some really great valuation work. And, he often says, it's not a stock market, it's a market of stocks. And it's no more apropos to think like that than today.
Yeah. Okay.
So
you want to move into technicals now?
Yeah, absolutely. Yeah. And I'll go pretty quick because, we've already kind of talked about this, how, part of the cautionary signals for not being, from going from bullish to just positive about the market. This is one of the things we look at that says, hey, the market might be a little tired as we go into the early part of the year. So this is the advanced decline line, and it's simply a measure of the difference between the number of stocks advancing versus declining. You subtract the latter from the former on a rolling basis. And you can see that in terms of the number of stocks advancing versus declining, that line is still going up. It's got a positive slope to it. It's in a long-term uptrend, but it started to roll over entire. When you really get worried about a bear market, you'll see the orange line, which is the S&P 500 price line, continue to go up while the blue line is going down. That's bad. That says the market's really getting narrow and you got negative divergence. That's not going on. The S&P has calmed and the number of advancing versus declining has rolled over a little bit. And, we saw that back in the fall of 2023, where you had it roll over. We got a couple of bad data points at that time that were false signals, and investors got just a little too nervous, and then we're off the races again. I think we'll kind of see that recover and go back up, but for right now, it's telling us, hey man, I need to take a rest. I'm up 60%, and I need to refuel a little bit. The next slide captures on the top the percent of stocks trading above their 50-day moving average, and then the 200 down below. And you can see how in October, they were at fairly high levels, both of them, and both have declined. Particularly the 50-day has declined, saying momentum's coming out of the market. Neither have gone down to oversold levels. They're kind of in neutral territory, which is why you say, okay, it's not terrible, but it certainly says, I'm kind of tired. I need to take a rest. So a lot of the momentum's come out. We got another slide in here, I think, on technicals. This gets at investor sentiment. And so when you get a bunch of bears out there, you see the orange lines. The ones that are going down tells you folks are bearish. If you get blue lines going above the zero line, that is a signal that there's a lot of bullishness. Notice how those blue lines have come in. So in terms of investors, we were at very bullish levels late in the year, and that's come out a little bit. And, you can stay bullish for some time. I'm actually glad to see some of the bullishness come off. But what I think is interesting is in terms of the strategists, you're seeing strategists price targets, pretty bullish. Investors all are kind of neutral, I'd say, on the market. So again, kind of a neutral signal, if you will. And we might have one other one in here.
I think we have two more.
Okay. We can skip. This is consumer confidence. Let's just go to the next. A lot of people just ask me this question, so I put this up there for fun. Hey, Jeff, Katrina, what happens after the market's been up 20% plus over the last 2 years? What does that tell you? Are you doomed to fail? Or, does the stock market do real well? And, it's kind of random here. I just throw this out for education purposes. Back in the 30s, I wouldn't even look at look at what was going on in the 30s. You had, World War and recession, depression, that we hadn't exited from and all that. But you had two really good years in 35 and 36, and then you had, negative year in 37. So throw that out. The 50s, you also had great 54 and 55, and then, kind of 2 years of not so hot. That's one, interesting data point. But in the 90s, wow, look at that, man. You keep on going. You had, a number of consecutive years of 20% plus. So, this really doesn't tell you anything, which way you go. You have to look at valuations, fundamental levels, technical trends to kind of determine on what you think is going to happen. But, kind of fun information.
Yeah, no, that's great. And I think kind of rounds out everything that we were alluding to on the FET slide. So let's actually switch gears now and talk about the wall of worry items. Yeah. And I think for the sake of time, I would say A lot of the headline worries are things, they're longer standing. We've been talking about these for, the last few years, whether continuing to monitor the Fed. Obviously, kind of the newer one is fiscal policies and what's going to happen around the new White House administration. You mentioned tariffs earlier, but I think maybe what makes the most sense is, for the most part, I think we feel like most of the headline worries are going to be adequately managed. And what would make most sense for the purposes of this conversation is to dive into some of the wild card risks. Okay,
so maybe what we do is take 1 second. If you go to the next slide, I'll just maybe tell the audience why we Fed policy, which is a legacy kind of thing. Just an example of why we think it will be adequately managed. This shows you what Fed funds rates have been going back to the 70, and the average is somewhere been just slightly under 5. That's right where we are. We're average. We're neutral. We're normal. What was abnormal was the 0 line that you saw for the longest time. Mm-hmm. So what they're doing, I think, is pretty normal. And if you look at the after inflation real Fed funds rate is at 4.5, and inflation is let's call it the 2.8. That's a 1.7% real Fed funds rate, which is right within that normal range. So they really don't have to do anything. They can be data dependent. So let's just go. We'll flip a couple of slides back, Katrina.
Go forward or back?
Go forward. Keep going forward. Keep going forward. Okay.
Don't you want to hit on tariffs?
I do.
On tariffs, yeah. Okay.
I do. So this, our message has been, kind of think like Walt Whitman or, Ted Lasso. Be curious, not judgmental. It's going to take a while. There is some things they can do with China because of the International Economic Emergency Powers Act, where he can, through executive order, this is Donald Trump and his administration, through executive order, put tariffs on in China, which, there's for national security reasons, very valid reasons to do that. But I want to make sure that everybody knows we're not going from 0 to 60% tariffs on China. These are just general product categories. Mm-hmm. These were already started to be instituted in his first term. Biden kept them and increased them a little bit. And so some of the product categories are anywhere from 25 to 50% already. So we're not going from 0 to 60. These will be incremental. And it's probably very valid that tariffs they are employed with China in terms of looking at this issue, both to protect our intellectual capital and to help motivate companies to diversify their supply chain so it's not so concentrated in China. This is realistic. But if you go to the next slide, there's you with our friends in Europe and Mexico, Canada, that will take an act of legislation to layer on significant tariffs there. They are not our enemies. There's not the International Economic Emergency Powers Act that can protect you. These are friendly countries. So that will take votes of Congress with very tight majorities. And you got to just wait and see what will happen. And we do think that those are more negotiating ploys to address issues with regard to immigration that the administration wants to address, and with regard to some bad traffic, whether it be drugs or any other products that we don't want to see flooding, in here. So I think that's more negotiation and just headline stuff. At the end of the day, I want to put it in perspective. This is the tariff rate going back to the 1930s. Rates were as high as 20% tariff rates. These are average tariff rates on U.S. imports from foreign countries. And they just came down significantly over time. But even after all that the Trump administration did in 2016, 17, and 18, they budged a little bit, but the average tariff rate went up to 3.5% or so. And that was mostly China. we don't think it will be significantly different from that in terms of impact that time. But let's don't judge. It's probably more of a 26 issue. And will it be inflationary or not? There are things and studies that will tell you deportation and shrinking our labor force is much more inflationary than tariffs. So stay tuned. We'll update you as things play out.
Yeah. No, that's great. So then let's get into the first wild card risk with the potential rising deficits and interest rates. This continues to be a topic around the U.S. debt situation. And so what's your perspective on, has it grown to crisis levels that could cause rates to surge and be a market spoiler? Let's talk about that.
Yeah, and I think we have a bunch of slides. This is the biggest risk. We call it a wild card risk, but the risk of rising rates can spoil a nice equity party. And, they've kind of hovered in this 3.75 to 5% range for some time, which is a comfortable range. It gets uncomfortable when you pierce through that kind of 5% level. So we want to look at where they are, the trend in 10-year treasuries, and the why to them. Well, right now, let's call it around 4.6 to 4.7%. Well, one of the concerns is, if they go up because economic growth is stronger than expected, that's okay. That's a good reason for rates to go up. If they go up because everyone talks about the bond vigilantes, if no one wants to buy our bonds and we get the bond vigilantes demanding higher rates because they're nervous about our federal deficit, that would be a problem. Our base case is not that they surge through that 5%, 5.5% threshold and get really ugly. We think they're going to stay tight. But we get good questions. The bearish camp really hits us hard. So, a couple quick slides. Why are we nervous that rates might rise because of fiscal debt? Well, trend in government spending. This shows you on that first slide that if you go back one, Katrina.
Oh, there we go.
If the government spending is a percent of GDP, there's consumer, there's business investment, there's government, and then there's international export minus import. Government spending has gone from, let's call it 18% of GDP if you go back to the millennium, beginning of the millennium, now to 24% or so. It's come down from the pandemic, but it's still 24%. And that's a big shift. That's getting people's attention. We're spending a lot. The government is. If you look at the next slide, that captures the deficit. And these are in dollar terms, where you see deficits of 3 billion-ish or 3 trillion-ish, during pandemic periods. And now they've come in a little bit to less than 2 trillion. But as a percent of GDP, the deficit spending, annual deficits have gone from, we'll call it 70%-ish to 120%-ish. Or the debt has down below, and the deficits have gone from 3%-ish to a double digit pay to about half that, currently. So debt has risen, annual deficits have gotten deeper, and that's getting people's attention. Another thing that people are nervous about is, if you look on the next slide, we have the net interest costs on our debt as a percent in the red, or the orange, as a percent of tax revenues. And you can see how it is really surged from, we'll call it 10%-ish to, on the left-hand axis there, to 17-18% of tax revenues. Whenever you get there, Congress gets really nervous about that, and that's a high level. So is it a problem? Or isn't it a problem? If we go to the next slide. One of the issues we have to face when our interest costs are like that is the structure of it. Too much of it is short term. We need to extend it, make it longer term. And it would have been nice to have done that when rates were lower. But, you're vulnerable to rising rates if most of your stuff comes due that's short. Scott Bessent is the Secretary of Treasury. And we think that was a great nominee and great call. He's both a tariff moderate and, he's a bond market expert. So he's concerned about this, and that gives us comfort. But again, is it a problem? People will say all the time, is our debt a problem? Go to the next slide. Not yet. This, tells you in the blue lines and that red line trend, that's what foreigners are doing to our debt. They're buying our debt. And we remain the reserve currency of the world. Our treasury auctions are going well. And when you get nervous is when you are no longer the economic envy of the world and when people aren't buying your bonds. On the next slide, a real signal for if this becomes a problem, when it will become a problem. You can see on that bar below, that is the trend in the US dollar. Our US dollar is trending up in terms of strength versus other currencies, and it is strong. So when the world sneezes, they buy our bonds, they want our dollar, and we kind of have a deal with the rest of the world. We are the consumer, the global consumer of last resort. We innovate. We produce strong GDP. We buy the rest of the world's products, and they take our money and they buy our bonds. And until they start buying, Saudi Arabian bonds or Chinese bonds or Russian bonds, which is not going to happen, or euros, we're okay. So these are the things that we monitor. And we do feel that with inflation calming, with the economy on solid ground, the Fed pausing, maybe a couple more cuts, that interest rates should kind of hover in a very healthy range and not surge to the upside. But we'll watch it because that's the biggest risk.
Yeah. So then we've got about 4 minutes left, so we still have time. Let's cover the second wildcard risk that we mentioned on the slide around earnings and profit margins. Whoops, I'm going too fast here. Or no, here I am. They might fall if they were to fall short if recent improvements in labor productivity stalls. Like, what are your thoughts there?
Yeah, we see positive trends in labor productivity, which is wonderful. Unit labor costs coming in, and a pretty strong economy and the implementation of AI and other things. And we are so much a different index than we were years ago. We're much more in communication services, technology, and those are all high profit margin businesses, and they're rising. So we expect profit margins to continue to trend in a healthy manner. But I'll just tell you right now, if labor productivity for some reason falls short, if there are policies that threaten labor productivity and this trend in margin, and we see that rolling over, that's going to be, we reserve our right to change our view. Our base case is that we'll see this healthy trend, but we're watching this like a hawk. If this doesn't continue to hold steady and play out, that's a risk, Katrina, that we'll be watching.
Yeah. Let's go ahead and move to this slide here. I know this is one we always like to talk about.
Yeah, this is probably a good one to close down on because, you have these great themes and positive themes and super, contrarian bullish themes for 2 years. And then you come out and you start talking about clear air turbulence and maybe could be misunderstood. What we're saying is a good solid year, but you're going to have intra-year corrections. And this is a slide that shows why if the FVTs are positive, it pays to be positive, not negative. The blue bars are the calendar year S&P 500 returns going back to 1980. About 75% of the time, you can see those blue bars are going up, which means they're positive. A few times they're going down. But when they are, the FVTs are not positive. But the red dots show you that even in good years where the bars are going up, you can hit air pockets. A great example is, look at 2020. An extreme example is 2020. Red dot shows that the S&P 500 in about 4 weeks fell 35%. That can scare you to death if you're not strapped in. Well, but for the full year, that's price only. That's not total return. the S&P 500 in 2020, even in a year of pandemic and economic shutdown, was up 18% because there was smart policy going on that prevented a protracted recession. It was over quickly. So I'm just here to tell you, we kind of see a red dot that could be, 10, 15% negative in the year, intra-year. But at the end of the year, we think that blue bar and price only will say 12%, 66. That's our base case. And we'll be monitoring these wildcard risks because Katrina and I have to come back mid-year to
Yeah, absolutely. Yeah, we'll do a check-in there. Well, yep. Jeff, thank you so much for joining and for all of your remarks today. Want to thank our audience for joining. We greatly appreciate you taking time out of your day to tune in, providing us the opportunity to serve you. We want to wish you a very healthy and prosperous 2025. And as Jeff mentioned, please mark your calendars to join us again mid-July, where we will do a mid-year review and a recap of the first half of 2025. Have a great day, and we appreciate you joining.